Good morning, everyone. Today, I want to talk about a subject that holds the power to transform not just your financial future, but your mindset towards building wealth. The stock market and ETF investments are not just tools of the wealthy, they are opportunities. Investing in the stock market is one of the most powerful ways to grow wealth over time. And the earlier you begin, the greater the potential benefits. Starting early allows you to take full advantage of the compounding effect, where your money earns returns on both the principal and the previously earned returns. This snowball effect accelerates growth over the years, creating a significant difference in wealth compared to starting later. For example, a person investing at 25 has a much larger time horizon to let their investments grow compared to someone starting at 40. Even small, consistent contributions can yield substantial results over time, highlighting the importance of taking action as early as possible. Compound interest is often called the eighth wonder of the world because of its ability to turn modest investments into considerable wealth. It works by reinvesting your earnings, allowing your money to grow exponentially. Imagine investing $10,000 at an annual return of 8%. In 10 years, your investment could nearly double to $21,589. But if you let it sit for 20 years, it would grow to $46,610. And after 30 years, it could exceed $100,000. The longer your money stays invested, the greater the impact of compounding. This process demonstrates that time in the market is more critical than timing the market. By staying invested and allowing compound interest to work its magic, you can achieve financial goals that might otherwise seem out of reach. ETFs, or exchange-traded funds, have revolutionized the way individuals invest by providing diversification, cost efficiency, and ease of access. Unlike individual stocks, ETFs are baskets of securities that track an index, sector, or theme. This diversification minimizes the risk of relying on the performance of a single stock. For beginners and seasoned investors alike, ETFs offer an excellent way to participate in the market without needing extensive knowledge of individual companies. Additionally, ETFs often have lower expense ratios compared to mutual funds, making them a cost-effective option. They also provide liquidity, allowing investors to buy and sell shares during market hours just like stocks. This combination of benefits makes ETFs a cornerstone of any well-rounded investment portfolio. Many people hesitate to invest due to fear and misconceptions about the stock market. The media often amplifies market volatility, creating an impression that investing is akin to gambling. However, this perspective overlooks the fact that the stock market, over the long term, has consistently delivered positive returns. Education and understanding are key to overcoming these fears. By learning about the fundamentals of investing, the historical performance of markets, and the importance of diversification, individuals can build the confidence needed to start their investment journey. Risk is a natural part of investing, but it can be managed effectively through proper planning and a long-term outlook. Facing these fears is a critical step toward financial empowerment. Short-term trading often captures headlines, but long-term investing is where true wealth is built. The allure of quick profits can lead to impulsive decisions and emotional trading, which often result in losses. Long-term investment strategies focus on buying quality assets and holding them through market fluctuations. This approach minimizes the impact of short-term volatility and allows investments to grow steadily over time. Historical data shows that the stock market tends to recover from downturns and reach new highs, rewarding patient investors. Long-term investing also reduces transaction costs and capital gains taxes, further enhancing returns. By adopting a long-term perspective, investors can navigate market uncertainties with confidence and achieve their financial objectives. Patience and consistency are the backbone of successful investing. The most common mistake is trying to chase short-term gains or abandoning the market during downturns. Building wealth is not about making one or two lucky decisions, but about consistently investing over time. Even during periods of market volatility, staying disciplined and sticking to a plan is essential. Regularly contributing to your investments, regardless of market conditions, ensures that you buy assets at various price points, averaging out costs over time. This strategy, known as dollar cost averaging, helps mitigate the risk of market timing. Patience allows your investments to grow uninterrupted, while consistency ensures that you stay on track to meet your goals. Together, these principles create a robust foundation for long-term financial success.